If you want to become more financially educated, the reality is that you don't need to work in finance and you definitely don't need a degree in finance. What you really need are a few simple habits that you can apply consistently. In this video, I'm going to share 9 small habits you can begin today. Most of these habits take less than 5 minutes each week, but if you stay consistent with them, they can greatly improve your financial knowledge over time. Let's begin with tiny habit number 1, which is discovering your real cost of time. Take 5 minutes this week to calculate what your true hourly earnings actually are, because in many cases, it's lower than what you see on your paycheck. In my 20s, I had a job in the gaming industry that paid me $60,000 per year, and I worked 40 hours each week. Since I took about 2 weeks of vacation each year, that meant I worked roughly 50 weeks annually. If you divide $60,000 by those working hours, it looks like I earned about $30 per hour. However, I also had to commute around 20 minutes each way, and I spent about 10 minutes every morning getting ready for work at home. Altogether, that added almost another hour to my daily schedule. Another important factor is that my $60,000 salary was gross income before taxes. After accounting for taxes and commute time, my real hourly rate ended up being about $20.88 per hour. That number represented my actual value per hour. Once you understand your true hourly rate, you can start evaluating purchases in a completely different way. For example, a $200 dinner is not just $200 anymore. It represents nearly 9 or 10 hours of your working time. A $40,000 car might equal an entire year of your labor. Highly successful people understand that time is the only limited resource we all have. That's why they constantly ask themselves whether a purchase is worth the number of life hours it requires. When you begin thinking about spending in terms of time instead of dollars, you start recognizing the true relationship between time and money. If you want to calculate your own number, here's a simple framework. First, determine your after-tax take-home income. Second, calculate your yearly working hours. If you work 50 weeks per year at 40 hours per week, that equals around 2,000 hours. Then add extra hours, such as commuting time, overtime, or preparation time. Finally, divide your take-home pay by the total number of hours worked. In my situation, it was $47,000 after tax divided by 2,150 total hours, which resulted in $20.88 per hour. If you feel comfortable sharing your real hourly rate, leave it in the comments. I'd love to hear what your number looks like. Tiny habit number 2 is to automate your savings before you have the chance to spend the money. Research consistently shows that people who automatically save money are more likely to reach their savings goals than those who save manually. From a psychological perspective, this makes sense. If part of your paycheck automatically moves into savings or investments, as soon as you get paid, you never feel tempted to spend that money. Setting this up usually takes only 5 to 10 minutes and can last for the entire year. You can do it through your employer's payroll system or by setting an automatic transfer inside your online banking account. For example, I personally get paid once per month on the 21st. The salary goes into my checking account, which I use for bills, living expenses, and everyday spending, but a small percentage automatically moves into my investment account for the future. If you can automate at least 10% of your take-home income into savings or investments, you will already be ahead of many people. Increasing that amount to 15% or even 20% can make an even bigger difference. The third habit is what I call the monthly financial check-in. Choose a specific day every month to review your finances. I personally do it at the end of each month, but you can choose any day like the 10th, the 15th, or the 1st. The important thing is consistency. During this review, look at all your income and spending from the previous month. Categorize your expenses into 3 groups: needs, wants, and savings. A popular guideline is the 50-30-20 rule. Around 50% of your income should go toward needs such as housing, groceries, transportation, utilities, and insurance. About 30% should go toward wants like entertainment, dining out, hobbies, and shopping. The remaining 20% should go toward savings or financial goals. During your monthly check-in, evaluate whether your spending roughly fits this framework. Maybe you discover that your needs actually take up 58% of your income, your savings are only 15%, and your wants are 26%. In that case, you might want to reduce certain expenses in the needs category so you can increase savings. Some costs like rent or car payments are difficult to change quickly, but others like insurance, phone plans, internet bills, groceries, or utilities can sometimes be reduced with a simple phone call. Even saving $10 per month on a bill adds up to more than $120 per year. Small improvements can stack together and create meaningful savings. Tiny habit number 4 is understanding the difference between assets and liabilities. Everything you spend money on generally falls into one of two categories. Either it puts money into your pocket over time, or it takes money out of your pocket. For example, a car is usually considered a liability. It costs money for insurance, fuel, repairs, and it loses value over time. Loans are also liabilities because they require you to make payments. On the other hand, assets are things that generate income or grow in value. A rental property that produces monthly rent is an asset. Dividend-paying stocks that provide regular payouts are also assets. Before making a major purchase, ask yourself a simple question. Will this item make me money or cost me money over time? This simple question can dramatically change how you view spending decisions. Habit number 5 is to track your net worth every quarter. Just like tracking calories or workout progress helps with fitness, monitoring your finances helps you stay aware of your financial situation. Your net worth is calculated by adding all your assets and subtracting your liabilities. For example, imagine you own a house worth $100,000 and have $25,000 in savings and investments, but you owe $30,000 on a car loan. Your net worth would be $100,000 plus $25,000, $30,000, $95,000. Tracking this number every 3 months gives you a clearer picture of your financial progress over time. Habit number 6 is negotiating one bill every quarter. Choose a bill that feels higher than it should be and contact the company. Explain that you've been a loyal customer, but the current price is becoming difficult to manage. Mention that you've seen similar services offered by competitors at lower prices. Ask politely if there are any discounts, promotions, or alternative plans available. Companies often prefer keeping an existing customer at a lower price rather than losing them completely. Habit number 7 is investing in yourself and your skills. You are actually your most valuable financial asset. Over a lifetime, the average person might earn between $2 million and $3 million in total income. If improving your skills increases your earning potential by just 10%, that could add $200,000 to $300,000 to your lifetime earnings. Learning new skills, gaining certifications, or improving your education can significantly increase your opportunities. Habit number 8 is starting to invest as early as possible. Time is extremely powerful when it comes to investing because of compound growth. Someone who invests early for only 10 years can sometimes end up with more money than someone who waits 10 years but invests for the next 30 years. That's because the early investor's money has more time to grow. Even small contributions like $50 or $100 per month can grow significantly over many years. Low-cost index funds are a simple option for beginners because they track the overall market and historically average around 8 to 10% returns annually. Finally, habit number 9 is celebrating your financial victories. No matter how small the progress is, acknowledging your achievements helps maintain motivation. You might celebrate saving your first $1,000, reaching $5,000, or achieving a 20% savings rate. The reward doesn't have to be huge. It could be a nice dinner, something you enjoy, or a small personal treat. Celebrating progress makes the journey toward financial independence feel rewarding rather than exhausting. Financial literacy is like running a marathon. You train gradually, stay disciplined, and celebrate milestones along the way. If you remain patient, consistent, and focused on long-term progress, you will steadily build wealth and strengthen your financial knowledge.